The Fed making history today, and for the first time ever, began buying corporate debt ETFs. The unprecedented move driving an explosion in the corporate debt market, $910 billion. That's how much corporate debt has been issued this year alone, and that is up 92% from a year ago. And get this, according to a new survey by Bank of America, corporate bond investors are now the most bullish they have been since 2006. So with the Fed officially in the market, is it now the time to sell that debt? Guy.
I'm not a bond person, as you know, and the short answer is probably no. I mean, if they're going to backstop things and as vibrant as the market seems to be, you probably got to hold on. But with that said, you know where I stand on this, and I think it's ridiculous that they're going down this avenue. And the next stop is probably going to be individual equities at some point, which is really ridiculous. I'm a big believer in corporate Darwinism. Allow it to manifest and let the chips fall where they may. And the Fed is just taking price discovery out of the equation. So as much as I'd like to say sell into the Fed, I mean, the old adage, don't fight them, probably holds true in corporate bonds as well.
Are you still short HYG, Karen?
Yeah, I'm short HYG, I'm short LQD, which are really sort of somewhat hedges against the banks, although they didn't work out today. I mean, I think what the Fed has done is just absolutely brilliant, just by saying we're going to do this in the future. They announced this in March. They didn't even get started until today, and yet this sort of instantaneous healing of the corporate bond market is really extraordinary. You talked about those issuances; those are gigantic numbers, which also helps the banks. I mean, you have Citi and J.P. Morgan and Bank of America. I mean, their capital markets desks have not been this busy in years, so that's good for them. But I think it's a bit of a buy the rumor, sell the news, in that we don't know exactly how they're going to be putting the money to work, right? We know it's up until September 30th of 2020, although it could be extended. The first phase is going to be their biggest phase, what they call the stabilization phase. But in my view, stabilization has already happened. And we're not going to see, maybe once a week, we might see an update on what they've bought. And I don't know that they really need to put it all to work. It's successfully, they've been successful in what they've tried to do, which is stabilize the credit market. So kudos to them. I don't know how they get out of it, but maybe they can just go slow for a while and kick the can down the road.
Yeah.
I don't know.
Our next guest says the Fed should not be buying corporate debt. Let's bring in Jim Bianco, Bianco Research. Jim, why not?
I think that they're opening up a can of worms, and just a little nuance in the conversation before. The Fed started buying bond ETFs today. They haven't yet started buying corporate debt. That's still another ways away. They've got some operational issues they've got to work out, but they've also promised us that they will do it. There was, as Karen said, a massive announcement effect on it in late March when they made the announcement that all the debt markets turned around and opened up. It allowed a lot of companies to issue bonds in order to replace their credit lines that they were drawing down on. But the Fed is not going to then walk away after the announcement. They're going to keep buying. But today was a watershed day in that they bought ETFs. Now, the big problem is, I think that they've got twofold problem. One, how to get out of it is going to be a big problem for them. I'm not even sure how they even end it at this point. I know September 30th is a date they're going to end it, but technically they need the Treasury's approval to do that as well too. They need the Treasury's approval to change these programs in any way. 5 weeks before the election, the Trump administration is going to say, no, you don't have to keep supporting the markets anymore. So of course that's going to get extended and then extended and extended. And so they're opening up. They may have solved a short-term problem in March and April that the markets were being dysfunctional. But as Warren Buffett said, there might be extreme long-term costs to this as we go forward from here.
Well, one long-term cost, Jim, obviously could be, in terms of short-term solving the problem, you're solving the short-term liquidity problem. But as we get out of this pandemic, we might have businesses and consumer behaviors that change fundamentally, and you may have a solvency issue on your hand, and all of a sudden the Fed is holding the bag there. I mean, is that what you mean by the problem is how does the Fed get out of this thing?
Yeah. Well, I think that there's two problems that the Fed's going to have. First of all, is the solvency issue. Now, the way The market is thinking about this, and let me use some of the examples like Six Flags or Carnival Cruise that has raised a lot of money, is they've raised enough money through the debt market that they don't need to have any revenues till next summer. And then the argument is by the summer of 21, they should be restarted at some point, and then they can pay off that debt. And the bondholders, knowing the Fed has got a backstop, which is a big thing, that's why you've got the most bullish since 2006. The underlying theme there is, of course, I'm going to be bullish on the bond market. The Fed is behind this thing and making sure it's going to be together. So why wouldn't I buy it? So you buy Carnival Cruise, you buy Six Flags on the idea you can get them through to next summer, and then they can restart. So if that's an assumption that we'll have to see whether or not that actually works. The second problem the Fed's going to have when you start getting into corporations is you have the potential of a restructuring. You have the potential of having to make a vote on how to run the business. They desperately don't want to do that, but they might be forced into those types of proxy battles or types of restructuring type of votes that need to be happening when you own less than investment grade junk on a company that needs restructuring. So they're going to have another issue with that as well, too.
Tim, you got a question?
Hey, Jim, really clear thoughts. Thank you. Are we not now Japan and ECB? I mean, the ECB in the summer of 2014 used the exact same backdrop. And by the way, we're going to negative rates. Fed fund futures are there. So what is different about the Fed than the BOJ and the ECB right now?
The only big difference right now is one, like you said, we are going to negative rates. But the Fed has been insistent they don't want to do it. And Jay Powell's going to speak tomorrow, and supposedly he's going to say, we're not going to go to negative rates. And then you can punch out Fed fund futures on your screen, and you'll see they're going to price in negative rates. So they're supposedly not going to listen to him. So they say they don't want to do it, but the Japanese were very much in favor of it. But I think the bigger thing we have to be careful of is after 2014 and especially 2016, when the Japanese ratcheted it up, liquidity in their bond market disappeared. It's 10% of what it used to be 5 years ago. There are whole days when government bonds go in the Japanese government bond market that don't trade once. If you nationalize a market, you take it over like that, you shove out all the private sector players, all the brokers and the dealers go away, and you have no more liquidity, and it becomes a permanent fixture of the central bank or the government itself. And that's a dangerous place to be in the long term. The Japanese have found that out because they really can't do anything with their markets and with their economy with it. And I hope we don't get to that point as well.
Jim, it's always great to speak with you. Thanks. Jim
Thank
Bianco, Bianco Research. Grasso, what are your thoughts here?
So I respect Jim. I like his work. But as he just finished off, he hopes we don't get there yet. So I don't think we're there just yet. But what was the alternative? So in March, if we didn't hear the Fed make any of these statements, where would the market have gone to? Now, I get it. People, want to see the chips fall and lie where they may. But I think the Fed actually saved the equity market. And if you look at the HYG, it jumped 24% from that March low, but it's starting to roll over now. So I think people know the script. How do they play it from here? I think you have the Fed as the bond backstop for the foreseeable future. And I think we are in a holding pattern for many things for the next couple of months. But I don't think that we are past the point of no return just yet.